Hey, Bulls and Bears, welcome back. It is December 21st, 2022, back with another dose of economic reality. Okay, let's get into it. Thank you for those of you that tuned into my last video. Actually, you guys really let me have it on my last video. I tried to have a little fun. I tried to talk about some things a little bit outside the box, but still in the financial economic realm. And you guys nailed me on that one. You guys, 20 of you unsubscribed. I got the most thumbs down that I've gotten in like a year. Wow. So I guess I won't try to joke around and have any fun. But thanks for those of you that did watch that gave me a thumbs up. Let's get into the news today. The economy is continuing to punish the average working person. And you're not going to see it when you look at the financial news. I was watching a couple of the news channels today. It was all about the stock market. It was all about which stock to buy, earnings, dividends. And sure, those things are fine if you have money to invest. But most people don't have extra money to invest. In fact, and I've said this statistic multiple times, but here's another update on this. The U.S. average U.S. person, about 75% of the people, are at the lowest savings rate that they've been in since the financial crisis. And this has been put out now by a few different internet publications like CNBC Online. I rarely see it talked about, though, on the cable channels, the financial news channels, CNBC, etc. And it's just going to continue to get worse. And interest rates rising now, record debt, credit card debt, auto loan debt. I mean, we are, as working people, it's not looking so good. For those that do have money to invest in the stock market, then you're likely in the small segment of the population that is not living paycheck to paycheck. But it's even getting harder now for people making six figures. A couple of reports ago, we talked about how six-figure income earners, about half of them are living paycheck to paycheck. So it's getting absolutely nightmarish and just more insane every day I look at the news. Here's some of the latest news here. We're going to talk about several different sectors of the economy here. Housing. U.S. existing home sales fell for 10th straight month, and that's the worst stretch since 1999. So this plunge in home sales is now worse than the prior housing bubble. We're going all the way back to 1999, over 20 years ago. Existing home sales plunged 7.7% to a seasonally adjusted annual rate of 4.09 million units last month, the lowest level since May 2020. They're talking about the plunge. But overall, we're seeing over 20 years now. The National Association of Realtors said on Wednesday, outside the plunge during the first wave of the health crisis, the spring of 2020, that was the lowest level since November 2010. As far as the plunge in sales goes, that's the worst that we've seen since the onset of the health crisis, one, since 2010, two. But the length of this now, 10 straight months, the number of months in a row that we've seen home sales fall, that is what takes us back more than 20 years. We haven't seen this long of a stretch of falling home sales for over 20 years. So nobody should be surprised at this. Rising rates, the debt levels, the housing market is going to continue to soften. They're trying to suppress mortgage rates. Imagine if rates were allowed to rise beyond what they are now, and how much worse it would be, worse than what we're seeing right now, a lot worse. Let's talk about real quick what's happening in New York. The super rich are fleeing New York. We see this exodus of the wealthy from high tax states. There was a lot of celebrities, wealthy people that left California. A lot of them went to Texas, many to Tennessee. Too many to name. But now out of New York also, super rich New Yorkers, including billionaire Carl Icahn, are fleeing the Big Apple in droves. And it talks about the states that they're going to here. To put this into perspective, the 41,000 filers in the state of New York, the top 1%, basically that's 41,000, pay more than 40% of all their income in taxes. Wow. The 450,000 filers that make up the top 10% pay about 2/3 of all income taxes. In other words, the remaining 90% of taxpayers contribute to about 1/3 of the city's income tax revenue. Well, the people that are paying a lot, but those are the people that are fleeing. Where are they going? Number one, Florida. Number two, Texas. Number three, Arizona. So no surprise there. So what are these states going to do when the bulk of their tax-paying base, and it's only a small portion of the population, but because they're super wealthy, they pay a big chunk on the total taxes. What are these states going to do? They're going to be broke, and they're going to be trying to raise the taxes on other people that aren't so wealthy, people that are already living paycheck to paycheck. So it's not good, and it's just going to continue to worsen. And that's the way this thing's going to go down. Americans' personal savings rate nears all-time low. We're talking about right around 2005. Now, 2005 is still a couple years before the housing bubble went bust, and that was the other time when savings for Americans were as low as they are right now. So it took a couple years after that before the housing market finally imploded. But remember what they did to keep the housing market from imploding sooner. We had all these insane loans, liar loans, no document loans, stated income loans, adjustable rate mortgages, subprime loans to infinity. I mean, it was a huge bomb that was just getting ready to blow. And those loose lending, it was the loose lending that kept it going even a couple years past when most people were absolute almost zero in their savings account. So now we're at about 2.3% personal savings rate, and that's down from 7.3% just 1 year ago. So look at that plunge in the average person's savings rate just from a year ago, from 7.3% down to 2.3%. So ask yourself, where is it going to be next year, a year from now, or even the middle of next year? Where is it going to be if we took that big of a drop just from 1 year to the next to where we are now? Interest rates are higher now. Cost of living is not coming down. The cost of electricity, utilities, we're seeing a little bit of relief here and there, but not much relief at all to dig people out of this hole, that's for sure. Real estate expert issues price warning. The People's Corporation chairman say rapidly rising interest rates may have taken away consumers' purchasing power. Oh, you think so? It's funny how these CEOs come out with the obvious, things that most people already know. Let's take a look at some other news here. The perfect storm arrives. Massive wave of car repossessions and loan defaults to trigger market disaster and cripple the U.S. economy. For almost a year now, we've been tracking several key databases, and this is one of them. The loan defaults in the automobiles. Home defaults haven't really started surging yet. They've increased slightly, but we're just getting into, I think, the time when this is going to accelerate. Let's talk about shortages. CVS Walgreens limit sales of pain medications amid shortage. We warned everybody that this was going to happen. No surprise. We don't manufacture enough things here in the United States. And it's interesting, I was looking at the inflation numbers. Countries that manufacture a lot have lower inflation. I looked at China, it was 2.3% inflation. Here we are over 7%, and that's the falsified number. But yeah, they manufacture a lot in China. We don't, and we're paying a lot more for goods and services. It's just going to continue to worsen here. FedEx misses on revenue, cuts another $1 billion in costs. So this is another warning that we've been talking about. When FedEx is warning and laying off people around the holiday shopping season, and now they're going to cut another $1 billion in costs. What is cost cutting? Where does that usually show up? That's jobs, layoffs. And they also trimmed their outlook on continued demand weakness. So more warnings out of FedEx. No surprise, right? We're just going to continue to see news like this. It's not going to be any surprise to us here, but to most of the population, they probably don't even see this because they watch the news and it talks about the stock market. Crazy. Let's talk about this. Americans reported mental health at new low. This is out of Gallup. This is a Gallup poll. 75% said it was good, but only 31% said it was excellent, their mental health, their state of mental health. So that puts the portion of the population that's considering themselves not in excellent mental health about 70%, but people that don't even call themselves or put themselves in the category of good for mental health, that's about 25% of the people. 25% of the people wouldn't call themselves in a good mental state right now, and a lot of that has to do with the financial situation. If we look at relationships, marriages. We see that the number one cause of the number one cause of distress in a marriage is financial issues. We see households now more than ever having to work, um, both spouses working a job, and if it's not, it's one spouse working more than one job just to try to make ends meet. But they'll just go ahead and chalk that up as good news because that's more jobs being added. When people go out and take a second job, they put that in the jobs number and they turn that negative thing into a positive thing. It's wacky and it's ridiculous, but that's what they're doing. One thing in real estate, or one area of real estate that's not going down, is farmland. Midwest farmland boom. Prices increased 20% in the third quarter from a year earlier. Uh, that was way beyond just residential real estate. U.S. farmland escapes real estate slump as prices soar to new records. So we're seeing a slowdown in residential real estate, but a surge in farmland costs. And that's out of Bloomberg. And we see a lot of big money coming in and buying up a lot of the farmland here. Not a good thing because a lot of them are not really farming the land. They're just buying it up to hoard it. And you're seeing the prices skyrocket because of it. So now the average farmer that wants to maybe buy a few acres to farm and actually use the land, they're going to get priced out. Sounds familiar, right? Sounds a lot like what happened with residential real estate here. Young adults are particularly vulnerable to delinquencies. Listen to this out of CNBC. 1 in 5 have debt in collections now, young adults. 18 to 24-year-olds, 1 in 5 have debt now that's in collections. And that's with most of that population still living at home. And that's with not even having to pay their student loans. Remember that we're still in that freeze phase right now where people don't have to pay their student loans. Even with that, 1 in 5 people are in collections. Wow, folks. This is just every day I read the news, it's continuing to get worse. Either way, thanks for being here, everybody. Keep stacking, and we'll see you next time. Bye for now, and peace.